Hey guys, Ken Boyd with the Accounting Accidentally website, where you'll find hundreds of blog posts and links to about 350 of my YouTube videos on accounting. So I came across an interesting article. This happens to be September of 2020. Capital spending plays catch up for now. And the gist of this article is that after delaying capital spending purchases during the pandemic, companies are starting to catch up and buy more assets to use in their business. So this has a couple of impacts for the business. The first is businesses need to increase capital spending that they've put off during the pandemic. Companies can issue stock or debt to raise capital to buy assets, but if you raise stock by issuing stock, some of it's dilute shareholder investment, and that impacts a shareholder's return on investment. So this is I'm going to Excel, and this is a spreadsheet that I've used before. And I want to specifically talk about stock options and warrants. So we start off sort of a before and after picture. We have before earnings per share of 88 cents per share for Levi Jean Company. And if I click on that, it's simply net income of $7,000 divided by 8,000 shares of common stock outstanding, which you see up above. But then we grant stock options to Joe Clark, who's the CEO of Levi. He can purchase 100 shares at 35. The current market's below the stock option price, so Joe's going to wait until the stock price gets above the option price of 35, and he's going to buy shares at 35. The journal entry on Levi's books is we increase capital stock and additional paid-in capital, and adds up to $100 a share. 100 shares times 35 or $3,500. The challenge, though, and this is what relates to the broader question, is that dilutes earnings per share, because note that net income didn't change. It's still $7,000. However, now it's divided by 8,100 shares because we issued 100 more shares to the CEO. Same dollar amount of income divided by more shares. Earnings per share has now decreased to 86 cents a share. So if you're a shareholder, you may be a little annoyed that the company's earnings per share went down, because that means that your stock may be less valuable. Similar issue with a warrant. A warrant I have attached to this bond. Here's a corporate bond for IBM, and there's a warrant attached that allows the holder to buy 100 shares at $35 a share, has an expiration date. It's a sweetener because a warrant makes the corporate bond more attractive, which is why warrants are issued. So it's the same process, except in this case, rather than being granted stock options, Bob Smith in this case, is going to tear off that warrant, if you will, use the warrant and exercise and buy more shares. So same journal entry. We issue common stock at par of $1. We have additional paid-in capital at 34. The total is 100 shares times $35 a share. This is the journal entry on the issuer's books, Levi. And again, earnings per share is now diluted because we have the same $7,000 in earnings, but now that is divided by 8,100 shares, which you have in pink, sort of that color there. So earnings per share is diluted. So the impact on the shareholder is earnings per share goes down. The shareholder may be annoyed by that because their individual share is generating less earnings per share, and the value of their investment may go down. So turning all the way back to this original point, some events dilute shareholders' investments, and that impacts the shareholders' return on investment. I also wanted to mention, when you go to the Accounting Accidentally homepage, either on the Get It Now button or in the download, I offer at this point 22 spreadsheets that explain various topics in accounting. You'll see a list of them here. Find the topics you want. Here's an example of the spreadsheet you get with a YouTube link. And you get the spreadsheet I used to make the video. You can email me at ken@stltest.net. I'll send you a link from Hightail. You can download the spreadsheets either all at once or one at a time. You'll get some time to do the download. Thanks for watching. We'll see you next time.